Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, now let's think about this. There's no real body, so who's in control? Okay, the market opened and closed at the same level. So here is a market that's nobody's in control. The bulls and the bears are in a stalemate. So on this doji session, the market is in balance between the bulls and the bears. And how does it help you? Well, one of the ways is based on Warren Buffett's rules of money management. Okay, he has two rules. Rule 1, okay, don't lose money. Rule 2, don't forget Rule 1. So let's see how even this basic information about candlesticks can help you avoid a bad trade. So here the market's holding the highs fairly well in the red box, but look at those small real bodies. What is that telling you? Okay, here in this tall white candle, the bulls are in charge, and these small real bodies are telling us the market's in balance between the bulls and the bears. What does that mean for your trading? Well, the market's in equilibrium, and what that does is increase the likelihood of the market reversing. So here would be either a good shorting opportunity, or you would know not to be buying here because the market is in balance. Okay, all with single candlestick lines. Now, a basic candlestick line is called a hammer, and this is the criteria. Okay, the market's in the downtrend, and you have a very long lower shadow showing us the market is rejecting lower levels. Looks like a hammer. Okay, so here, for example, we have a hammer. And a lot of these candlestick signals, the low of the candlestick signal is going to be support or resistance based on the close. So notice the low of the hammer on that on that yellow line is a support area based on a close. See how the market got under it in recession, but it still held it on a close, so the hammer is still a support area. Okay, we'll look at this candlestick signal later, the green wrapping around the red. That's a bullish engulfing pattern. Okay, so if you buy in the hammer, the risk is to under the hammer based on the close. Whenever you do a trade, there's always a price that says you're wrong. Now, the opposite of the hammer is a shooting star, very long upper shadow. Okay, the market's rejecting higher levels. Okay, and again, the simplicity of the candlesticks. You don't have to be a candlestick expert to understand what this is saying. The market, at some point during the session, doesn't matter what time frame this is. This could be a daily, okay, weekly, and an intraday. Here, the market opened over here. Over here, we know it opened there because it's a white real body. It rallied during the session. Let's say it's a 60-minute chart, and then by the end of the session, closed near the lows, or in this case, at the lows. So visually, we could see the market is rejecting higher levels. Now, we have a series of what we call Nison trading principles. These are core trading principles that I've derived over my 35 years of trading with both candlesticks and Western indicators. And one of these key points is that the more signals you have, either candlestick signals or Western signals, or if a candle signal confirms a Western signal, the greater the probability of a turn, okay, because you're having a bunch of series of technical indicators converging at the same area. So whatever Western indicator you now use, or whatever you learned at ISE, or whatever you will be using in the future, Western indicator, it's really easy and powerful to combine candles with Western indicators. And I do that all the time. So, in fact, here was an interview by Active Trader magazine a few years ago. And in the article, I really pointed out for my trading, I use Eastern and Western strategies. In other words, candlesticks combined with Western technical techniques. So, for example, nothing more basic than resistance, okay? And late last year, okay, we're back up here now again in the euro, but you see this resistance area I'm drawing in red, okay? That would be resistance on a bar chart, right? Whatever you do on a bar chart, you do on a candlestick chart. And the shooting star is confirming the resistance area. And this is what I mean by a combination of candles and Western indicators, all right? Here we have the candlesticks east confirming a Western indicator. All right, and my target would be the bottom end of the trading range. So if you shorted on the shooting star, your stop would be a high above, stop above the shooting star, and the target would be towards here, the bottom end of the trading range. Now, this is one of the books I had translated. I have dozens of books translated from Japanese to English, and in one of the books it says this: combinations of bullish and bearish candle lines indicate the direction of the market and investors' psychological conflicts. Okay, I like to say every candle pattern tells a story. So let's think about the story of this pattern. Here we have a bullish engulfing pattern, the white candle wrapping around the black real body. The bulls are taking off from the bears. Okay, so every pattern tells a story. Psychologically, we see the bulls are taking control of the market from the bears. Okay, it's a bottom reversal signal. Okay, the market should be in a downtrend. You need a downtrend to reverse. And the low of the bullish engulfing pattern, the lowest low of the two candles, should be a support area. So here we have back-to-back bullish engulfing patterns. Now, first of all, notice we have the shooting star that I just circled. Now we have a bullish engulfing pattern here, all right? And then another one right over here. So the fact that you have two is really reinforcing a support area. This happens to be the U.S.-Canadian support area right around the 117.50 area. And my target would be, the recent highs over here. So here we see the candles, a shooting star confirming a high, and two bullish engulfing patterns confirming an important low. Now here we have a Western signal called a descending triangle. So you have lower highs, as shown by the blue line. I could make it a little more exact, okay, this red line, and a solid support area. Now, descending triangle is normally bearish because the market, the sellers are coming in at lower price levels. All right, so one might think about selling this, but look at this. Look at this. Look at this. Everywhere, let me clear it out to make it a little easier. Okay, so everywhere where there's a check mark still showing is a bullish engulfing pattern. So in spite of the lower highs, I'd be very nervous about selling it. In fact, if you're a little bit more risk-oriented, you could actually buy, okay, with, especially over here. And with this, I'd give it a little more leeway rather than having a stop at the low of that bullish engulfing pattern, have a stop at the low of this bullish engulfing pattern. So, and this is what happened. Okay, by the way, I'm just showing you the yellow arrows of bullish engulfing pattern. This is what happened after. So can you imagine shorting here because of lower highs? Look how much you would have lost. So knowing not to go short, thanks to the bullish engulfing patterns, kept you from losing hundreds and hundreds of pips. So one of the best ways to make money is not to lose money. That's what the title of this slide is all about. Now, the opposite of the bullish engulfing pattern is the bearish engulfing pattern. Okay, so here we have a black real body wrapping around a white real body. The bears are taking over from the bulls. Okay, very easy, very powerful. Okay, candlesticks, very simple to use, very powerful in diagnosis. Okay, so the high of the bearish engulfing pattern should be resistance area. So the bears are taking over from the bulls. So here we have a bearish engulfing pattern. And notice something interesting. Even before the bearish engulfing pattern, what do we have warning us that the market was losing steam? The doji. Okay. So on this tall white candle that I just highlighted with the red arrow, the bulls are in charge. And the next session, with that doji, the trend has gone from up to neutral in one candlestick line. Okay? And then with the bearish engulfing pattern at the blue arrow, the bears have taken control of the market. Great shorting opportunity because you have a series of bearish signals. Of course, always having a stop. I'd have a stop above, I'd say, the 125.40 area. And my target would be the recent low. So if you did this trade based on candles, you're looking at maybe a couple hundred pips in the downside in your favor. Classic bearish engulfing pattern. Okay, black, or in this case red. Remember, it depends on your charting platform. Red wrapping around green. Okay, and on the left side, classic bullish engulfing pattern. Green wrapping around red. And the low of the bullish engulfing pattern is a support area. look at this. Bulls in charge on this green one. Bears try to take over. Bearish engulfing pattern. Bearish engulfing pattern. Bearish engulfing pattern. Boy, if that doesn't give you warning that, in this case, the yen, the dollar yen, had a lot of problems, okay, you didn't know how to read candles. Okay, as shown here on the title, reading the market's message quickly and accurately, and that's what the candlesticks are going to let you do once you learn how to use them correctly. If I had only known this. Look out below. What a great short. Okay. Now, notice something interesting here on the blue line. I'll highlight on the red arrow. See how the market broke above resistance? All right? And it says, let's buy. Why wouldn't we be buying it here? Although the market closed slightly above resistance, why wouldn't we be buying it? Look at a small real body. It's almost like a doji line, right? It's telling us that although the market made a new high close, I'd be very nervous about buying it, or if we did, to buy it very lightly. Now notice the slide says trading box ranges. The Japanese call box ranges what we in the West call lateral ranges. So if you sold it here, let's say on the bearish engulfing pattern over here, we'd look for a bottom end, of the recent lows. This is a box range over here. Resistance, support. So let's say when the market sells off, you see a bullish engulfing pattern. I'm highlighting here, green wrapping around the red. My target would be the top end of the box range, right here. Okay, so get rid of a lot of this stuff here. Okay, so let's say you bought on this bullish engulfing pattern, and your target are the highs over here. And look what you get at resistance, a doji. Perfect time to take profit. So if you bought at 122.60 and exited, and it doesn't mean you don't take some profits here. Maybe I'll take some profits at the shooting star. But let's say you're out of your complete position at 123.60, you're looking at quite a few pips in your favor, all right? And what I'd recommend doing if you're getting the market moving in a direction like this, take some profits at the shooting star or use a trailing stop, blocking some of the profits. Now, one of the things I'd mentioned before, and just want to emphasize now, is really important because the candlesticks use the same information as a bar chart. That means all your favorite Western indicators can be used on a candlestick chart. So, for example, just very basic resistance. A shooting star confirms the resistance. All right, that's a great potential trade setup, of course, always having a stop that says you're wrong. All right? Hundreds of pips if I had only seen this. And many of you use Fibonacci retracements. Okay? So here we have a Fibonacci retracement of the sell-off shown in the blue arrow. And right at the Fib 50% level, we have a bearish engulfing pattern. Okay, so the point is that whatever your Western indicators you're using now, continue using. All right? And the main thing is the reason successful traders or confident traders use candlesticks is because they use the early reversal signals of what we, as we mentioned before, Nison candlesticks to enter and exit. The candles are very often the first to give you a potential reversal signal, so you get in before the potential big move. So, for example, here we have a shooting star at the arrow. Okay, and what two factors, one candle and one Western, would cause you to cover shorts or to go long after this black candle? Well, let's think about this. Okay, bears are in charge. Okay, over here, this is the candle I'm asking about. Over here, let's think about what's happening. The small real body is showing us there's an equilibrium almost between the bulls and the bears. And from a Western perspective, isn't this confirming a support level shown by the two red lines? So definitely, I would not go short here. I would not cover shorts here where I put an X because the bears are in charge. But between the small real body at the check mark and the successful test of support, I would certainly consider covering shorts, or if you're flat, to go long. But if you're shorter on the shooting star that I just circled, I would take profits at the check mark because of the candle signal, the small real body, and the market's confirming support. So let's go through what we learned today, all right, how candlesticks can be used in all time frames, anything from intraday to daily, or even weekly. I don't think many of you use weekly, but, whatever time frame you're looking at, how the candles reveal market psychology. If you have a bullish engulfing pattern, a white candle wrapping on a black real body, the bulls are in charge. Protect trading capital. If you have a new high, say the market breaks above resistance with a doji, Okay, I'd be a little nervous about buying it because I like to see highs made with a tall white real body, the power of combining candlesticks and Western indicators, and how candles can improve market timing. And this is what it's all about, okay, those early reversal signals.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.